If you follow the Barefoot Investor, you've probably considered Hostplus for your insurance. When you've been looking at this, you might have noticed two key terminologies they use, both fixed insurance and unitised cover. But what do these two terminologies mean? In today's video, I'm going to share with you a bit of background about each of these different definitions, as well as provide you with some context to understand which of these two options might be the best for you. But before we get started, last year I shared a video on the government's My Health record. When researching this, I came across an article in the Sydney Morning Herald by Ben Grubb, which was amazing. Ben explained the complexity of the terms and conditions by comparing them to things that we were familiar with in our everyday life, such as the terms and conditions for signing up for Facebook, joining a bank account, or even lodging a tax return. What he then did was he compared that with our human nature not to read terms and conditions. He then highlighted statistically how likely we are as humans not to read terms and conditions. And believe it or not, 80% of us are guilty of not reading these documents. The reason I'm telling you this is to highlight the importance of context. Ben could have very easily said to you that the My Health record terms and conditions were 8,000 words long, and you would have been, But instead, by anchoring these things to things that we're familiar with, he provided you with some context. Now, Gary Vee, a major online player, says that content is king, but context is God. So today, I'm going to do the same thing for you when it comes to considering the fixed and unitised cover with Hostplus. To make it easier for you, I've broken it down into three key sections. First, we're going to have a look at the fixed cover and what this means. Secondly, we look at the unitised cover and do exactly the same thing there. And finally, I'll bring it all together and provide you some context around how to make the perfect decision for your situation. But before we get started, I'm going to assume again that you know how much insurance you need. Whether you've used Scott's multiple of salary method, you've jumped on the Hostplus website and used their tool, but if you are stuck, there's also a link in the notes below that you can do your very own personalised report using my method. But whatever method you've used, make sure that you don't go any further in this video until you've done this step. When you apply for insurance and nominate the fixed cover option, the amount of insurance that you initially apply for will always remain the same unless you specifically make a request to change it. For example, if you apply for $1 million worth of Life and TPD cover initially, when you get to your policy renewal each year, the level of cover that you have will maintain at that $1 million, whether that be next year, 5 years, or 10 years in the future. If you do choose this option, the thing that you need to be careful of is the cost. You see, as we get older, it's statistically more likely that we're going to need to claim on these insurance policies. Whilst your cover levels remain fixed, you'll notice that each year your premiums get more expensive. To have a look at this in more detail, I've put together an example for you to walk through the impact that age has on cost. In this example, for $1 million worth of Life and TPD cover, I've looked at the cost of it for a 30-year-old, 40-year-old, 50-year-old, and 60-year-old. You'll notice that at 30, the cost of the premiums is about $1,000. At 40, the premium jumps to about $2,000. At 50, you're looking at about $4,000 for that same level of cover. And finally, should you still require this same level of insurance at age 60, you're going to need to spend about $12,500 a year on your premiums. What often happens is you forget to come back and revisit your insurances for a period of time. And what's happened in this same time frame is that the premiums have gone up. As these premiums are debited directly from your super fund, we're less vigilant than if that same amount of premium was coming from our bank account. The result is having less money in your superannuation balance in later years. When you apply for unitised cover, once you've determined how much insurance you need, Hostplus has a table for working out the value of each unit based on your age. Secondly, they have a table to tell you how much each unit will cost based on your occupation. Again, I've included the links below the video for you so you can jump through and have a look at what your unit value and cost per unit would be based on your exact scenario. In a unitised cover option, instead of the amount of insurance that you have remaining the same in the future, the cost of this insurance will remain the same for you. Again, the insurance company knows that the older we get, the more likely it is that you're going to need to claim on your insurances. So instead of increasing the price, what they do is they reduce the amount of cover that they'll provide you in the event that you need to claim. I've done another example to highlight how this would work. In this scenario, you'll notice that the premium remains the same at about $900 a year in each of these different scenarios. At age 30, that premium will get you about $1 million worth of cover. At age 40, you're looking at about that same $1 million worth of cover. But from 40 to 50, you're going to see a significant drop off in how much insurance that same premium will get you. At age 50, you'll be insured for about $260,000. And at age 60, that same premium will only buy you about $70,000 worth of insurance. So now you've seen the differences between the two, which option's the best one for you? To answer that question, let's go back to the start and see how you determine how much insurance you need. I'm not a massive fan of using the simple multiple of salary calculator. And the reason for this, it focuses on an output rather than looking at the needs behind the cover levels that have been suggested. Instead, I believe in 4 key principles when it comes to insuring yourself and your family. Number 1, in the event of something happening to you, you should clear the debt on your family home. Number 2 is to allow for the surviving parent to become super mum or super dad. And what I mean by that is allow them to focus on the kids rather than having to focus on getting to work. Number 3 is never have more cover than you need. So this is taking off any net investment assets that you have to reduce that sum insured that you require. And finally, number 4, I believe you should have enough money to pay for a funeral and final expenses. But how does this practically work? I've given a basic example of 2 different families to prove my point. In family number 1, we've got a couple in their 30s. They've got 2 young kids, aged 5 and 7. They owe about $700,000 on their mortgage. They've got a family income of about $150,000. Using Scott's multiple of salary method, they'd need about $1.5 million worth of insurance. Using my method, instead of that, they'd need about 1.6, so slightly more, but you can see they're pretty similar. Family number 2, this couple's a little bit older, they're in their 40s. Their kids are a little bit older, they're 15 and 17. Their debt has been paid down to about $400,000, and their family income has increased slightly to about $200,000. Using Scott's multiple of salary method again, they would need about $2 million worth of life and TPD cover. Using my method, I believe this family needs about $1.3 million to put them in exactly the same position should anything happen than the earlier family. Now that I've highlighted these 2 examples, would you agree that the younger couple needs more cover than the older couple? By looking at these 2 examples, I hope you can see that the premise that I use is that the younger couple would need more insurance than the older couple. The reason I highlight this example for you is to help make a decision as to which of the fixed and unitised cover options you should choose. If the need for insurance reduces over time, surely that unitised cover would be the ultimate selection. And this is where I believe there's a bit of a difference. You see, I would much prefer the fixed cover option, and the reason for this is control. Assuming that you take the time to revisit this at periodic increments as opposed to just letting it go and the premiums running out of control, a fixed cover option will allow you to adjust the cover that you need based on your specific needs at a certain period of time. In the unitised cover option, the insurance company is going to dictate how much insurance you can have at that time. So I hope this has been helpful in clarifying the difference between the 2 options and provide you with some context around which of these options might be best for you.